So today we're going to talk about capital stacks in real estate syndications. And this basically is where you as investors sit as related to the debt on the property, the lenders, in other words, and other investors, because there can be sort of a hierarchy within every investment. So it's important to understand where you are, because the same deal for one investor could be a big win, while for another investor it could mean no profit at all. So we want to make sure we understand where we are and that we're comfortable with the risks of that particular place in the capital stack. So we need to understand what it is and why it matters, and to see why performance isn't really the only metric in the deals, but also the structure of the deal. So with that, let's dive in. All right, why capital structure matters. So structure often determines the outcome more than the property performance, at least per investor roles, right? So the same property can produce, as I said, a safe, steady return for one investor and maybe high volatility, equity, wipeout outcome for another. Like it really can be dramatically different. Obviously, if the deal performs as projected, then everybody gets what they were expecting, but that's not always the outcome. Hopefully we have more of those than not, but you just always need to understand the risk. So most people obsess over cap rates and rent growth, but sophisticated investors, they also obsess a little bit over the structure. So my job is not just to chase high returns for me and for those who invest alongside me, but it's also to make sure people understand what their seat is within that structure, what it means as far as their risks and their returns, and my other job is to avoid fragile structures and kind of spot those. So I'm going to give you a little peek behind the curtains on what kinds of things I look for, right? So first, it's really important to understand the difference between debt and equity and what that really means. So the debt, this is your lenders, this is your bank, this is your biggest kind of partner in the deal, right? So the debt is money loaned to the deal. The lender is a creditor, not an owner. And they have the legal right to repayment, which investors don't. So that's a big difference. So there are loan documents that state exactly how and when they will get paid back. And it is secured by a loan or a mortgage rather, or a lien on the property itself. And they're going to get paid first before any investors or anybody else gets paid. The lender's going to get paid. So they have priority claim on the asset as a default, and returns are usually fixed and contractually defined. So everything is spelled out. There's no, well, if it performs better, they'll make a little more or something like that. That doesn't happen with the lenders. So for the lender, they're very low risk compared to equity. There's also a much lower upside, right? The project does well, they don't make any more money, but there's strong downside protection. That's what lenders want. And that's why they're willing to take maybe, 6% on something, where an investor is going to want at least twice that in most cases, right? Then we have the equity position. So these are owners. Equity means ownership, right? So equity is money invested for ownership. The investors become an owner, not a creditor. So there's no guarantee of payments here, right? The payments are dependent on the performance of the property as a whole. And they only get paid after the debt obligations are met, but they do participate in the upside sometimes, unless it's structured where, you can have equity ownership that is a set return as well, but you have the potential for upside and appreciation of that value. And unfortunately, they also absorb losses first, because that's part of being an owner. If the whole thing loses, so do you. And you do get the tax benefits, which a lender doesn't get any of those. There's a higher risk for sure. There's higher potential returns because of that. Risk to reward balance there, but there's no contractual obligations for payouts. Obviously, if the property is making money and the lenders are paid, then there's an agreement that says the owner's splitting that, but it's not a contract in the same way that a lender has. So essentially, the creditor gets paid because they are owed money, and equity investors get paid only if the deal performs. All right. So okay, capital stack. So we're going to get into some of the definitions. This might sound a little bit boring, but this is important to understand. So the first thing up is the senior debt. So this is the first lien with the first claim on cash flow and property in event of a default. Can be permanent or bridge. So what does that mean? I think we all understand what permanent debt is, but what is bridge debt? So it's a temporary senior loan, so meaning it's not designed to be there for 25, 30 years, right? But it's used to acquire, renovate, or stabilize a property before refinancing into that long-term permanent debt. So it typically has higher interest rates with variable rates, shorter maturities, and higher risk due to refinance and execution uncertainty. In other words, there's no guarantee of that refinancing. If the property wasn't stabilized, a long-term lender might not take it. So that adds a little bit of risk in there, right? Now, there are cases where some deals are only use bridge debt because they're not planning on holding it long term. And the reason they might do that is because the long-term debt, they're putting 20 to 30, sometimes even 40-year loans on these properties, and they're willing to accept a much lower interest rate because of that. But if you pay it off early, they don't make as much money as they were anticipating making. So they'll hit you with a prepayment penalty, and that can be very expensive. So if you're not planning on holding the property long term, you might choose to go with bridge debt instead. But then you have those risks of variable rates and refinancing and all that, so you have to find other ways to mitigate those risks. So that's where you might hear something like a debt cap. You might say, okay, it's a variable rate, but I can't go above this much. We're going to pay to lock it down at this particular rate. And they might pay in advance to have the right to extend the loan if it goes beyond whatever the initial agreed upon period, to take away that risk of, what if we can't refinance or we don't want to go into long-term debt. So there are ways to mitigate that kind of debt, but you need to understand it if you're investing in the deal. But you're either going to have senior permanent debt or you're going to have senior bridge debt, typically in every loan. Next is mezzanine debt, and you might not see this in every loan. Okay, so this is a secondary subordinate lien. So this is the equivalent of on your personal home, you have your primary mortgage, then you might have like a line of credit or something like that on there. So it's a second loan on there. It sits behind that senior debt, but ahead of equity still, because it's still a lender. And sometimes it's used to fill the gap between the senior debt and equity. So let me explain what that means, filling the gap. So sometimes it's planned and sometimes it's not planned, but it has to happen. So perhaps the deal needed, they have a senior, let's say it's a $10 million deal. Let's say the first senior loan is 80% of that. And then they're planning on raising 20% from investors. But that closing date was really short. It was a very short timeline, and maybe they only raised $1 million of that $2 million. So maybe they got mezzanine debt to fill the gap in between, $1 million short-term loan, until they can raise the rest of the equity that they need. So it might be a temporary thing that's in there. Sometimes it might be part of the plan from the beginning. So we'll discuss, when that may be the case and when it might not be. But basically that's what it is. It's filling that difference between the equity and the senior loans to make sure you got the whole amount covered. All right. After that, we have equity. And the first position there is the preferred equity. So this equity class is paid before common equity, often with a fixed or targeted return. All right, so what does that mean? So preferred just means that they're ahead of somebody else. Okay, that's all preferred means. It doesn't mean it's a guaranteed return. But oftentimes they'll say, okay, we're going to give you a preferred position in this capital stack in exchange for the fact that you don't make as much as the common equity might if the deal goes according to plan, right? So maybe it's a capped 8% return or 6% return, whatever it might be, but it's capped at something. But they get paid that before the common equity. But maybe the common equity is going to make 15 or 20% or more. They have that upside. But because they're common and they're further down in the stack, they take more risk. And so they do those higher rates. So that's kind of what preferred is. It's a position higher, but it's still not a loan. It doesn't guarantee payment. It's still performance-based. All right, then you've got the limited partners. So this is part of your common equity. So they're the passive investors that participate in profits after the debt and preferred equity are paid. All right, so when you see that 70-30 split or a preferred return or something like that that goes to the LPs, that's where this lies in there. General partners are also common equity. So same kind of thing. Everybody else has to get paid first. But they have an ownership position that gives them some control in the deal. They get to make the decisions, versus the LPs do not get that. So, and they might also earn some fees, and then the promote after that. So they might get some fees at the front end, might have an acquisition fee, they might get asset management fees to keep the company stable and running the asset throughout the whole period, but they don't get that big chunk at the end until those LPs are paid. So that's why the LPs are still higher in the stack than that, but that doesn't mean that they can't collect some fees potentially. It depends on what the fees are and how they're structured. We're not going to get into all of that. But after that, after the LPs are paid, then they do get a promote. So what is a promote? So that's our next one. So promote can also be called carried interest. So this is the share of the profits allocated to the general partners after investor return hurdles are met. Okay, so you got to pay the LPs first, and there's some sort of hurdle that they have to get over before the general partners get paid. All right, so what's a hurdle? So that is the minimum return investors must receive before the general partner is eligible to receive performance-based compensation. So maybe it says, okay, all your limited partners have to make 15% on their money first before the general partners get paid. Or they have a preferred return of, say, 7%. So they have to get paid 7% on what their investment was. So let's say you invested $100,000, you have to get paid $7,000 for every year that you're in the deal before there's maybe an equity split. And a common equity split would be like 60-40, 70-30, something like that. And so it might say, okay, so once they've received all their preferred return, or they met a 14% hurdle, however it's set up, then there's this equity split of everything above that is split 70-30. For example, 70% to the investors, 30% to general partners. That's pretty common. So that might be what the hurdle looks like. All right, the waterfall are the rules and the sequence of those that we just described. So the rules and sequence governing how cash flow and profits are distributed amongst the stakeholders, including any tiers, hurdles, or performance-based promote structure. So basically the waterfall is just what lays all this out, right? It's going to explain this to everybody who's invested, and you'll see this in all your investment documents. I'll explain all the rules. So that's called the waterfall. There's something called a tiered waterfall, okay? So this can also be called a promote step-up. So promote, again, is the money that the general partners make, right? And a step-up means at some point they might make more. So this is what a tiered waterfall is. So it's a compensation structure where the profit split between investors and the general partners changes at predefined performance thresholds. The general partners earn increasing promote percentages as the investor returns reach or exceed specific IRR targets. So I mentioned the example of 14% before, right? You could have that set up where, like, okay, once they reach 14 or 15%, now the general partners get a share. Or maybe it was 7% preferred return, and then there's that 70-30 split. Maybe there's some combination of that. Maybe it says, okay, once the LPs have gotten their 7% and they've reached a total return of 15% IRR, now the general partners, instead of getting that 70-30 split, it goes to a 50-50. So anything above the 15% or whatever it's set up to be is now a 50-50 split. Okay, so if they have something like that, so that's an extra incentive for them to make sure the LPs are getting paid a lot of money, because if the LPs make a ton, then the general partners are going to make even more, right? Because it's going to shift from that 70-30 to 50-50. And again, I'm just throwing out numbers, it can be set up any which way. But this is kind of some of the common numbers we often see. All right, so that's kind of the glossary. And I didn't want to gloss over that. See what I did there? That's awful. I'm sorry. All right. So does more debt mean higher investor returns? This is a question I get a lot. And the short answer is yes, it does. If the deal performs exactly as planned or better, more debt can increase equity return. But you've heard a lot of people say you don't want to be over leveraged, right? Because if you have too much debt, it could compromise the deal, because the debt always has to be paid. And if you have years where maybe the deal isn't performing as well and you have trouble paying that debt, it could cause a problem, even if later on it's going to do better or really exceed performance, but you have that little dip, it could make the lender nervous and they might want to take over the property or something, right? So you don't want to be over leveraged because that causes a problem, but as much leverage debt as you can have, the higher the returns are, because debt is a lot cheaper than equity, right? The investors, they want a bigger return. So the more investors you have, then the more people are splitting that return, right? Versus that bank loan, which maybe is only at, like I said, 6% or something, 5, 7, whatever it might be. But that's a lot less than investors are going to take. So obviously, the more of the total amount that you need to buy this property is allocated to that, the higher the returns for all the remaining investors. So yes, it can mean more if the deal goes according to plan. All right. So let's take a look at the capital stack and make sure everybody understands the seniority here. So pay attention to the arrows on the left, on the left and right here. So on the left side, it says risk increases as you move down. All right. So the further down the capital stack you are, the higher your risk is. Control increases as you move up. So the people at the top have the most loan. Now, of course, the returns are also risk adjusted, right? So your higher return potential is towards the bottom as well. So let's look at it. Who's at the very top? It's the senior debt, all right? It's got that first lien position and they get paid first. After that, if there's mezzanine debt, and a lot of them do not have that mezzanine debt, but if they do, that's going to sit right behind that. It's a higher risk than the senior debt, right? Because if there's like some foreclosure and there isn't enough money, a senior lender's getting paid first, so they're going to charge a higher rate. And then behind that is your preferred equity. Not guaranteed return, just means they're preferred. They're going to get paid before the others on the equity stack, but not before the lenders. And it's often a fixed or targeted return, and they're not going to get any more than that. It's very limited upside. So it might just say, hey, would you like to buy preferred equity at 10%, 9%, whatever it might be? You're not, okay, if it goes really great, going to get 15%. That's not going to happen. You're going to be limited there, okay? And then the LP equity. So this is common equity now. So that's investor capital participates in the upside, meaning it does well, you do better. It bears the market and execution risks, right? A lot more so than those other places. And then lastly, last to get paid are the general partners, but they could earn some fees in there to keep the company going for the sake of the property, right? But they also have control of the decision. So that's kind of how the capital stack looks. That's the order in which it appears. So let's talk about incentives by layer. Each layer behaves differently under stress, and control and risks are not even. They're very uneven, right? So if you follow the incentives, you'll understand the risks. So senior debt, they want payments on time, and they can force a sale or take over if the covenants are violated. So they have some muscle behind them there. Preferred equity, it wants returns to be current, right? They want to get paid now. They don't want it to be accumulated and paid later, which common equity, that's common, that you get paid later in the deal. They can force aggressive decisions. So sometimes they will write something in the covenant that depends on it, on the sale. But let's say it's a family office that's writing one big check for all of the pref equity versus just opening pref equity to all the investors. Anybody who wants to come in and get that position, they'll usually have less control. But if someone's writing a really large check for all of the preferred equity, then they might write clauses in there that says they can force the deal to refinance if they need to be paid out. They could force a sale, and they could force expenses to be cut. So they may have some power in there. The LP equity, they want stable cash flow and long-term upside, but they've got little control in there. General partners might be motivated to do deals to earn acquisition and asset management fees, even if the risk is elevated. So you have to be careful of that. You want to make sure there's good alignment with the LPs and the rest of the people in this deal, right? So when you review a deal, ask yourself, who gets paid no matter what? And who gets hurt first if things go sideways. All right, so we're going to look at a couple of scenarios. So the first one here, we've got 70% senior debt, 20% LP equity, and 10% general equity. This is a very common kind of breakup, right? So if the NOI, the net operating income, drops by 15%, let's say it's 15% below where it should be. Who gets hurt first in this particular scenario, right? So the debt's still going to get paid. At 15%, you should still have enough to pay the debt because most first lien holders, again, require a debt to service coverage ratio of about 1.2, 1.25. So 120% of the income is what should have been written in there for them to cover. So at 15%, they're not getting hurt at all right? LP and GP will both feel some pain, but the general partners still have some control of decisions. So they might just get, the distributions might drop, might not be as high as they were, or they might pause them until the property does better, right? You don't want to dip into your reserves if you don't have to. You want to make sure there's always adequate reserves in any deal you get into, so that's another thing. But yeah, so for LPs, this can be a very clean structure. It's very easy to understand. You know where you're at. And if the leverage is reasonable and the reserves are strong, this is usually a pretty safe deal. You just need to make sure you got good operators and all the other things that you evaluate on property. But it's pretty easy to understand and you know where you fall. Let's look at scenario B. So here we've got 65% debt, bridge debt. So, right, not long-term debt, but bridge debt. So that adds a little variance in there. Then you've got preferred equity at 15%. So it's a pretty big chunk. Then you've got 15% LP equity and 5% general partners. So a couple things to note here. You've got potential for a lot more returns to your LPs because you've got 80% in a lower range, right? So the LPs could get paid a lot more here, but there's also a lot more that gets paid before them in the equity stack, right? Your general partners have only 5% here versus 10% in the last one, which means they're getting paid less on the back end than they were in the previous equity stack. So you want to make sure that they're still incentivized to do that and they're not compensating by raising fees in other places. They should still just have reasonable fees in this kind of stack. So the bridge debt often has variable rates. We talked about that. Shorter terms and refinance risk. So we want to make sure that they're mitigating for those. Rate caps come to mind, extension of loans, those kinds of things. We want to watch out for those. The pref must get paid before the common equity. So this adds fixed pressure to the loan, right? And the LP could get completely squeezed out of the business if the business plan slips here, right? Because there's a lot above them. But if it goes according to plan, they might make a lot more. So just things to think about. You just always have to evaluate this. And you want to ask the sponsor why they need the preferred equity in here, right? Is that solving a capital need? Could they not get a loan for a higher amount for some reason? If so, what was that reason? And does it make sense? Is it, well, we bought the property when the occupancy was really low, right? And so the senior lenders wouldn't look at it or wouldn't give us as much loans. But we have a plan for fixing that, and it's a solid plan. Or is it, well, we just wanted to have more debt in here to prop up the returns for everybody. You just want to get a feel for why it's set up that way. Because is it a smart deal or is it just an overly aggressive deal is what you're trying to get at here. So, but again, if the answers seem valid, investors will get a higher return in a scenario like this due to that pref equity position being in there. So yeah, just gives you a little more pause, a little more to think about. It's not quite as simple as the first one. Now, scenario C, definitely not simple. So this is what we call an over-engineered capital stack. And I do see these, and sometimes they make sense, and sometimes they make no sense at all. So here we've got senior debt, then we've got mezzanine debts. We've got two lenders on here. Then we've got preferred equity, and then you've got your common equity, both the LP and GPs. And so it's very sponsor-favored risk here, so it's over-engineered. So you really have to ask yourself, first of all, do you understand the stack? Okay. With one read, do you know what's going on here? If not, the complexity has a tendency to favor sponsors and the insiders who fully understand this stuff. So you need to be a little more cautious when you see this kind of complexity. There's a lot more claim on the cash flow before common equity here. And when a structure is this complex, it could be a yellow flag, maybe even a red flag. It depends on the deal. So again, just start asking questions. That's really what it comes down to, is ask questions. Why is the structure needed? Try to determine if it's a valid need, or and why they need, or if they're just doing it in order to get the projections that they need to be able to sell it to the investors. Like, this is the only way we could get the returns to be at least a 16% or whatever they're aiming for, right? If they can't get to it any other way, you got to say, well, does that mean it's a little bit risky, right? So start asking questions. That's what it's all about. All right, we're going to talk about the cash flow waterfall. So we talked about the waterfall is how it all comes down. It's what outlines the risk. So first, there's the return of capital. This is the first thing that happens. So that's to everybody. So first, you're going to pay back your debt, and then you're going to pay back whatever your investors put in, the preferred return investors, as well as or preferred equity investors, as well as your common equity. All of that, everybody gets their initial capital back. That's number one. Okay. Then you're going to start paying preferred returns. All right. So sometimes there might be a preferred return of, say, 6 or 7% on the deal, but it may not have been paid current all the time. Maybe the first year they couldn't afford to pay any of it because they're busy making improvements to their property. Maybe the second year they paid half of it. Okay, so that accumulates and has to be paid at some point before there's equity split. So it's called a catch-up provision. So that's what happens. There's the catch-up that has to be paid. And then after that, there's the promote and the profit splits. So this is the promote that the general partners get part of, right? So maybe there's that 70-30 split. That's what happens at the end. So deals can look great on paper with big back-end payouts. Because a lot of the projections, they're based on what happens at the very end here, right? But if that structure delays or it's throttled, the LP distributions are kind of throttled back, then the IRR, remember the internal rate of return is based on how timely you get paid. So if everything is pushed to the end and it wasn't originally projected to do that, then your IRR is actually gonna drop. So what you want to do is you want to ask for a waterfall diagram at the beginning. So a lot of providers, sponsors will do this. They'll say, okay, year one, we expect you to get this much. Year two, this much. This year three, this much. And the projections that we're giving you, the IRR, the average annualized returns, all of that is based on the waterfall going like this. So if you start to see that shift where you're not getting paid on time, or you are getting paid more than that, then you know that your IRR is either dropping or going up. And you got to see, well, are they going to make up for this more later? Or is it going to slow down at some point? You know, again, everything is a projection when you first see it. But it's just nice to see that diagram to see, okay, the IRR that they're promising, or not promising, they never promise anything, right? That they're projecting is based on this timeline, just so you understand what that looks like. All right. All right. So here's a scenario. There's an investment, and you can either take part in the preferred equity at 8%, and it's capped, but gets paid before everybody else. There's no upside. Or you could come in as investor B and be part of the common equity, where you get the 70-30 split, right? But it's more volatile and participates in the upside. So you have to ask, what am I more comfortable with, right? Like, because you may have these choices. So you don't always just want to look at the overall returns. You want to say, okay, if you're a conservative investor versus a more risk or less risk averse investor, right? Which seat would you prefer to be in? These are the questions you want to be asking yourself. So a capital preservation investor might prefer that stable capped income of the investor A, and a growth oriented investor would likely choose to be common equity, that investor B, right? So yeah. All right, so the 3 questions to ask always is just who's in control, who loses first, who gets paid last. Those are questions. And I would probably add, am I comfortable with the risk versus the reward ratio? All right, that's it. Thank you guys so much. I really appreciate you coming, and reach out if you have any questions, if I can help with anything. Take care.